I realized that the Trump administration was suppressing the oil price. And I looked at the history of price suppression. And the last time that anyone had suppressed oil prices anywhere close to what they were doing in early 2025 was in the early, it was basically the Nixon era. And so here, I'm going to show you guys. I don't, again, this is not an offer. I'm just like providing some context on this. So hopefully this is okay. And again, not a solicitation. But I do think it's worth highlighting this specifically, um, to tie in sort of like what I'm doing here with this newsletter, with Bison Insights, as well as to share why it matters that there's this inflection, why you're so lucky to hear about it while it's happening instead of afterwards, like you normally do. And then what I think is going to come next. And again, no one knows the future. There's nothing that's certain, you know, do your own diligence, all that. And again, this is not, I'm showing you something from a white paper from my investment firm, but this is not a solicitation for that firm. It's the firm, frankly, only takes money from qualified, accredited investors, and there's a rigorous process to be able to invest. So really, truly not a solicitation. But here this is. Again, we published this April 25th, 2025. Everyone's panicking. All the folks you see on TV who are all magically bullish oil were all ultra bearish oil, telling everyone to sell everything and liquidate their oil stocks, which are now up 2 or 3 or 5x from there. And so the argument was there's a long-term growth trend for oil demand, which has held and actually exceeded despite the tariffs that were put in. And then there's just beautiful history that when oil prices fall and when oil stocks fall, there tends to be dramatic outperformance from there in oil stocks. And again, I wasn't calling a bottom. I was really excited and I really wanted to buy particular stocks here, but it was more that this looked, the degree of capitulation, the degree of bearishness felt, even though the stocks weren't down as much, it felt very, very similar to the COVID era and frankly similar to what we saw in 2008. True panic. And then unlike 2008, this was more oil focused, so it felt more similar to sort of the COVID sell-off. And I got a lot of flack for this, but in February of 2020, I sent out letters via my investment firm. We sent out letters to chief investment officers of um, 500, 400 institutions, endowments, foundations, pensions, saying that we thought it was a compelling time to invest in oil and gas stocks. And we got some like nasty replies, take us off your list, whatever, but physical letters, signed each one, physically mailed them out. They saw them and got some real sort of negative feedback in April of 2020, where a lot of the stocks of the sort I would have been buying for them were down, let's say 50%. But 18 months later from there, those stocks net from that February entry point were up tremendously, which I show in this next chart. And so I think this is similar to that. Obviously, we're in the middle of an upside shock, but here's the part, again, that people just don't appreciate about all this. You can get the timing completely wrong. You can go buy oil stocks a month before the world shuts down, buy them at a low enough valuation. You don't even have to buy the right ones. These are XOP returns. Again, for Bison did much, much better than this, but the XOP returns, buying oil stocks in February of 2020, XOP was up 185% by, what is it, mid to end 2023. Not even through 2022. It was really, truly remarkable. So I saw this, I wrote this, and I took all of my excess liquidity and I invested it into my investment firm, into my fund, my strategy, which again I'm not soliciting for, just giving you some background on. And I basically pounded the table again, went back to some of these folks. They all told me more emphatically to pound sand. Okay, fine. Right. Again, like you can show people the numbers, you can tell them what you're doing, you can even put a lot of your own money in, and they can ignore it and tell you to pound sand. Cool. Okay. Again, like some of it has to do with it not really being their money, and very sort of low, responsibility. Like there's no called strikes and so on. And some of it's also that, look, like I did experience a lot of negative volatility during COVID. So, it was not fun to be an investor with Bison in mid 2020. If you put in money in February, and even though there were these spectacular forward returns from there, the first couple of months were terrible, really, really terrible. And so, similarly, April was a really rough April of 2025 was a very, very rough month. I actually see I have a few clients in here who can probably attest to this. So, very, very rough. I saw the opportunity. I wrote about it and I pounded the table and, did not raise material dollars in, unfortunately. So what did I do? I turned around after having dumped my liquidity into this, into my fund. And I launched this newsletter. And the thought again was that I would be able to show this time as it was happening, what was happening, where I generated the returns, and let people come along for the ride if they opted in and paid a nominal amount. And so the amount I'm charging has risen a little, and people that have signed up, they basically these days you get locked in at whatever price you're signing up for, and for the early folks, we're going to sort of grandfather them in at a attractive rate in appreciation of their sort of early subscriptions. But the thought is to essentially allow people to opt in and have it be sort of a fair deal where they pay some nominal amount of money and get to see these ideas that I have confidence in. And I can't guarantee this, of course, but I put in writing, hey, here's what happened these last times. I don't think this time is different. And so far so good. And let's see, I'll show this. We just sent out a sales thing. If you're already a subscriber to Bison Insights, please don't be too offended with me sharing this. It's just sort of an update on sort of what's going on in the oil market, which I can go through for a second, but then sort of show what's happened so far with the ideas that I've shared with Bison Insights. And then I think the combination of sort of the historical accomplishments, and again, past performance may not be indicative, but I do think that strong past performance is an argument for attention and perhaps an argument for a subscription. And so I think so I'll get to the performance in a second. Just as an update, the last week, oil supplies continue to be constrained. China did not come to the rescue for the oil market. We keep having draws in inventories, and then bond yields are rising, which historically have been correlated with higher oil prices, and frankly, higher valuations for energy stocks and oil and gas, particularly oil producers and oil services companies. And so, these are very promising signs from here. So here's how the individual ideas have done. And you can tell I'm not lying, partly because about half the people watching this right now are paid subscribers, so they will know. And then partly because there's one idea that's down about 50%. It was probably a mistake in retrospect. We'll see. I haven't closed it out yet, but the best performing is up 602%. So it's roughly a 7x so far. And there was almost 4x that we closed out. And then there's a minus 47% idea. But most of the ideas have actually materially outperformed. And, there's, 3 ideas that have underperformed and 1 that's money losing. And so, and again, I don't mean to say that cavalierly. Obviously, I want there to be 0 money losing ideas, but there's also just a reality, which is that everything in finance involves risk. And if anyone tells you that they have a spotless track record, that they're never down for a month, that they're never whatever, they're just lying for the most part. And so again, the point of this is actually transparency and doing it in sort of an aligned manner. It's not to lie about this. If anything, I think this is sort of a call to action, hopefully for folks who are doing this, other folks who are doing this, to also provide this level of transparency on sort of idea returns. And there's too many folks, I think, both in the oil and gas space and broadly in sort of the financial newsletter space, who misrepresent, I think, is sort of the nicest way to say it, what they're up to and the performance of their ideas and so on. And so, my thought is, hey, I'll just show what I'm up to, show the performance of the ideas, show when they work and don't work, and hopefully over time, all of them will work. But there's a reality, which is that some of them won't work, and there will be periods of time where I look pretty dumb. I promise you. And we've already experienced a few sort of mini ones of those. So over here, just under that 110%, you can see there was a pretty big decline, I guess, drawdown in the performance for these ideas, and then similarly, end of 2025, there was also a drawdown. But the performance relative to XOP and relative to SPY, sort of these ETFs, which are easy to benchmark and don't require license fees. They're great, and the performance is great, and so far so good. So okay, so I think that's the starting point. Is so who are you? I'm a oil and gas investor. I run a investment firm, and the investment firm has done quite well. And then what is this? This is a set of ideas that I'm sharing that are thematic, where I have sort of sets of ideas. I was really interested in natural gas producers and sort of off the run, sort of mixed oil and gas producers sort of early on in this, because we were in sort of a very strong period for natural gas prices, which is part of where some of this outperformance of these ideas came from versus the oil index, as well as versus the market. And then it really made sense to push hard on oil starting in December or so, when people really capitulated again. You had this echo crash. So in 2020, you saw oil prices crash and oil go negative in April of 2020. And the stocks bottomed in early April, a couple of weeks actually before the oil price went negative. But then they crashed again after the summer of 2020, when it looked like there might be a second wave of lockdowns and so on. And so you had this amazing entry point in November of 2020, and a lot of capitulation when people are worried, hey, is this COVID thing going to last for a long time? These lockdowns going to last for a long time? And there was this just tremendous opportunity to come back in. Similarly, there was Liberation Day sell off, and then oil actually fell close to where it was. It might have even fallen a little lower than it was during Liberation Day in December of last year. And again, you had just almost unanimous call bearish oil, other than me, both via my investment firm and published here on Bison Insights. I published around that time article arguing that it was oil's turn in the commodity cycle, and boy was it ever. And at the same time, all these folks that are on TV and in Barron's and Wall Street Journal, all these places that are pushed to you, were all extremely bearish oil. And again, the data was there. And one other thing I'll point out, the performance of these ideas was spectacular before the Iran war. The Iran war, if you look at March, the idea is the composite was already up 70%. And at that time, XOP was up a lot less, and the stock market was up 5-10%, something like that. And so these ideas, they were working really well. I think I called the inflection nicely, both for these gas stocks earlier in the year, as well as for these off the run gas stocks that were, I mean, they've still done really well, sort of amazingly, even with natural gas not doing so great. And then called it on oil stocks. And again, I will get themes wrong and I will get ideas wrong. Past performance is not indicative. But again, I do think that past performance is an argument for attention and an argument for careful consideration. And so, and also, frankly, an argument for less careful consideration of these ordained oil gurus and pundits and all this nonsense who are just wrong all the time. And who, if you listen to them and shorted oil or whatever in December of 2025 or April of 2025, you would have lost quite a bit of money from following. And so, here, let's this, and then I'm gonna. So okay, so with that lead up, what am I seeing that I think is so fantastic? And what I am seeing is this. Jason B there you can get I'll post a link to it's like on Printify here. Let me just pull this up and put it in the chat. The point of this is not to sell hats, but I don't anyone that wants a hat, you're more than welcome to. And like I said previously, I'm donating the proceeds of these hat sales to charity. So far I've donated to the Houston Zoo, which felt appropriate, even though they don't have a bison, sadly. But and I think the next up is the Houston Science Museum, or Museum of, what is it, Natural Science and History or something. And then I'll decide what I'm donating to next. But so the major thing I'm seeing, thus the hat, sort of ridiculous, but I like it. We are seeing likely the bottom of the drilling rig cycle in North America, particularly in the US. I think that the drilling rig count in the US for oil rigs by the end of this year will be closer to 500 than 400, and it may exceed 500. And so that may sound aggressive, but it's also in line with history. And basically, originally, I had just shared this with paying subscribers, this analysis on historical rig response versus oil price movements. And then it became clear that this might help in terms of the broader sort of narrative and conversation on oil. And it still hasn't caught on, but don't you worry. In a month or two or three, you'll start seeing these ordained pundits. After a lot of these stocks will have doubled or tripled or whatever from here, you'll start seeing some of them talk about increased drilling rig activity and drill baby drill and so on. So just a bookmark this. Let's see when they show up and say it. By that point, we might be closer to 160 rig ads. And again, that's like a little high potentially, but maybe we'll be closer to 70 or 80 rigs added. At that point, I think we will have seen enormous moves in some of these oil services stocks, particularly some of the drilling rig stocks, where these companies have enormous financial and operating leverage and trade at large discount to their replacement cost and large discounts to their intrinsic value. Okay, let's see if I can get this working. It is lagging. Okay, here we go. Let's close this up. I'm not sure what happens when I do that. Okay, great. Okay, I posted, by the way, the Printify link if you want to check out some merch. Again, I donate the small net proceeds. I basically tried to price it to a point where I'll lose a little less money net, including the cost of my assistant who helps me with it. And I'm just donating the sort of gross proceeds, excluding the administrative cost or whatever of it. Okay, so what am I seeing? So one, there's big inventory declines, which is very promising. And the more inventories decline, the more rigs are going to run. And the higher oil prices go, the more rigs are going to run. So what am I seeing? I am seeing extremely cheap stocks. These are not the valuations that you would expect for capital-intensive businesses at large discounts to their replacement cost at the bottom of the cycle. What you should see is maybe something closer to Peer 4, but really you should see companies at the trough at close to 10 times EBITDA or 15 times EBITDA. This is what you've seen in past oilfield services cycles. This is what you've seen in other sort of deep value, asset intensive down cycles. And so I think people just like don't believe it. And then they also see the very high free cash flow yields, at least for some of these companies. And again, no secret, I'm a value investor. I really like these companies, and they're very, very cheap. And so they're very, very cheap. And it's extremely likely, in my view, that the drilling rig count will rise a lot. And these consensus expectations for valuation seem ultra conservative. If you plug in 100 rigs, forget 160 rigs added in the US sometime next year from, let's say start of this year, or from March of this year, you end up with numbers that are way beyond this and numbers that are almost embarrassing to show. So instead of showing the forecast potential numbers, I'm going to show another valuation approach, which I think is a reasonable approach for this sort of company, which is replacement cost. And I actually had the CFO of one of these companies on for the paid subscribers and did an interview with him. It's after their quarterly filing, everything's sort of out in the open, and had him walk through his approach to calculating replacement cost per share for his company, and then walk through how I was approaching it, where I got a pretty similar number to his. And, I think that in this drilling cycle, to the extent that we see a rig add percentage and a rig add sort of absolute number similar to past cycles, which is an if, but it's happened almost every cycle for the last many. So maybe this time is different, but I feel comfortable betting against the this time is different argument on this. Every time has been different at the time, and then in retrospect, it looked very similar. So if this time is similar, then these stocks might actually trade to a premium to replacement cost. And these two have roughly doubled since I shared the ideas. One of them I shared a couple months ago, one of them I shared last year. And there's a lot of room for upside from here just for them to trade up to replacement cost. And again, I think that they might trade to a premium to that. Both of them are very active in paying down debt or buying back shares. And so on a debt adjusted per share basis, they're actually increasing this imputed essentially replacement cost per share. And so also, I think both of them now are reinvesting in their fleets, which is also increasing this replacement value. I don't know what just happened now. Okay. So I think these things are very, very cheap. And I think we're in the middle, not even the middle, we're in the early stages of this inflection. And so as we're in the early stages of this inflection with stocks that are this cheap, I think it's extremely compelling to share this idea here. And I think it's extremely compelling to consider new ideas here. Again, I'm going to pull up this. I just love this one chart. I'm glad that I consulted with my assistant on this to figure out if we wanted to share this publicly, and I'm glad that we did. It's just so beautiful. And I've been very skeptical publicly about this whole Trump drill baby drill thing, and I don't know. I can't say that this is some sort of like 3D chess or anything like that, but I can say that however it's happening, we are in the early stages of a drilling boom, and it's wild to me to get to buy and own oilfield services stocks that are direct beneficiaries of this at a third of replacement cost with 20% plus free cash flow yields to the equity and sub 4 times enterprise value to EBITDA run rate metrics. Every drilling rig company I talk to tells me about how they're doing better, but the overall industry is still a little challenged. Every private operator I talk to, pretty much, at least the larger ones, are adding rigs, but they insist that their competitors are not adding rigs. And so this dichotomy is like probably the most hated cyclical recovery. Actually, it's not true. In 2009, I still remember this. I hated the cyclical recovery then. I was very young. I was working for this multi-billion-dollar family office. Met with all these people. I hated it. I couldn't believe that these oil companies, they were idiots. They were drilling again. What were they going to do? The world was in a terrible recession. And lo and behold, they were right and I was wrong. And, again, eventually they oversupplied the market. But what an incredible time to be drilling wells. I was very fortunate. I was an early investor in a phenomenal company. It still exists, called Northern Oil. I don't own it now. Just it's gone through a lot of changes and contortions or whatever. But early investor came in, bought as much of that stock as $2 a share, funded half the offering at $6 a share, and it went just basically straight up. Fidelity bought the $12 offering, the $15 offering, the $25 offering. I was out, and then I think they even funded the $40 offering, and I think that portfolio manager left Fidelity. I think I was told. So anyway, there were some amazing opportunities then. This is the epicenter of the opportunity from what I can tell. I see the folks that missed this on TV and in the news and in these investment publications telling everyone go here, go there, whatever. For the most part, they missed the last ones too. Even a few of the people that didn't miss the last ones, they're missing this. This is an incredible opportunity. I chat with the companies. They're just not seeing that much interest. I went to the investor day for one of these companies that I'm not invested in. Great company, really cheap, little more expensive than the ones that I own. Still great company. No one cared. It was all investment bank analysts. There were a few folks that were sort of like customers or ancillarily involved or whatever, but no one cared. It was great. Got to see their rigs, got to chat with their people, great people. They're getting really busy. Same story there, though. Oh yeah, we're getting more busy. We're getting inbounds, but our competitors aren't. And again, just absolute, with due respect to them and the rest of the companies, nonsense. Like the odds of one drilling rig company getting a lot of inbounds and getting to raise utilization and price, you can raise one potentially, but raising both concurrently, odds are your competitors are also picking up rigs, potentially a large number of rigs. So it's very exciting. I'm sharing a new idea this week. And hopefully this new idea will do as well as some of the past ideas, which of course I cannot guarantee. But these past ideas have done pretty great. And I think since this chart came out, OIH is actually down, and the first idea is up even more, and then the second idea is up even more. I think they both roughly doubled as of right now versus when I shared them. And I think this next idea could perform similarly. Obviously, no one knows for sure. I can't guarantee that. I can't promise that. I can speculate on how it may perform, and I think it may do very, very well. It's at the cheapest end of sort of the overall services complex, at least of a company of size and scale in its particular niche. And it's got a great story, and it's very well positioned, similar to this OFS idea number 2, very well positioned to outperform on the back of a large increase in rig activity. And so I'm looking for more of these ideas. If you have a great services related idea that you think is differentiated and ultra cheap, and please don't hesitate to reach out. I'm looking at a lot of these things. So far, the companies I own a lot of and that I've written about are companies that I've owned and or followed for years. This latest idea I owned in small size intermittently, and then got really excited when I realized that there was a major aspect of the company that people did not understand beyond just this drilling rig response. And I literally spent virtually every dollar of remaining liquidity, sort of similar to what I did in April of last year, where I dumped a whole bunch of money basically into one ultra discounted Canadian oil producer, which is up almost 4x from then. And again, past performance may not be indicative. Not all investors may experience the same returns, whatever, but I experienced that, and I'm really excited. I bought a lot of this next thing, and I'm excited to share the idea. I spoke with their CEO and their IR person on Friday, and it's great, and they're very honest. I like CEOs. I like management teams that are pretty non-promotional. It's way more fun to go tell the story when there's someone who's not boring, but just like a very sort of factual, straightforward person to be able to essentially riff off of. And so very reliable, very honest and upfront, and really excited about this next idea. It's going to be fun to share. I'm looking forward to hearing the feedback on it. And concurrently, like I'm very excited about these ideas that I've already shared. I think even though they've done quite well, I think there's a lot of upside in some of them. And one of the other interesting things I've seen, less on the oil field services side, more on the producers, is some of these management teams historically have been terrible at market timing. And some of the ones that have been the worst at market timing have started selling their own stocks. And so this may sound alarming or concerning or whatever, but it's been one of those interesting things where these particular companies, as well as executives like them who have behaved very pro-cyclically historically, them starting to sell some of their shares has historically been correlated with their shares subsequently rising a lot in